everyone. Thanks for coming out for our panel today. As Vince alluded to, we have some very cutting-edge institutions here as it relates to fund tokenization. These are folks that we've worked with, that we've partnered with. We're very excited to have this panel today. So, quick introductions. So, we have Mathias here, who's co-founder and CEO of Sygnum Bank. Sygnum Bank is the world's first digital asset bank regulated in Switzerland and Singapore. We have Andrew, Executive Director of UBS. UBS is global investment bank and wealth manager, and Andrew has led some of the major fund tokenization initiatives in Singapore under MAS's Project Guardian. And then finally, we have Emma, who's head of digital propositions and partnerships in APAC for Fidelity International. Fidelity International is a global asset manager with 860 billion in assets under management, and they've been a pioneer in institutional digital assets. So we want to frame the discussion with three parts. Essentially, we want to start with the market evolution, how we got to tokenized funds as a fund structure through time. It's taken us 100 years to get here, by the way. Ecosystem building. And then finally, we're going to talk about technology. So part one is all about market evolution. And if you look at the structure of funds over the past 100 years, there's been three critical paradigm shifts. The first has been in 1924, was the invention of the open-ended mutual fund. Most folks in this room, you have that in your retirement accounts. It took up until 1993 to get the ETF. So that was the next paradigm shift. 1993, we have the ETF. Then you look to 2022, then we start getting into tokenized funds. So the format of funds has changed, and the features of those funds have changed along with the technology. So the open question here, and I'll go left to right with our panelists, is as we see this evolution of traditionalized funds to ETFs, now to tokenized funds, how are each of your firms thinking about this transition from a business perspective? And also, maybe we'll start left to right with Mathias, Andrew, and Emma.
And the question is how we are seeing this. Okay, so I mean, first of all, you also mentioned it in one sentence before that it all took a bit longer than we all thought. I remember already sitting on panels like these 5-6 years ago and being convinced that tokenization of at that point it was company shares, etc., would really take off, and it took much longer. I think now we are at the point where some real traction is coming into it, and I think one of the key drivers was actually what it always is, and that is kind of investment opportunities evolving. And given the interest rate cycle that we've just gone through with the interest rate hikes following the pandemic and the inflation associated with it, has really led to the innovators in the space, those bringing together the infrastructure, which I'm sure we'll be talking about, to make this work end to end, really seeing value and seeing yield, right? By, for example, finding ways to bringing money market funds, US Treasury bills, etc., on chain. So I think it's ultimately driven by investment opportunity linked to the crypto ecosystem, the foundations, those managing significant treasury holdings that just want to have these assets on chain, given the interest rate environment to bring it there. And that has led to players like ourselves and others coming together and really trying to figure out how this value chain can be structured for it to work. And I think this year has probably been an important inflection point in that context. And we can go into more detail later.
Yeah, no, I definitely echo a lot of those points. So I think that the way that we kind of think about it is you're talking about market structure or the mechanics. So why funds? Like a fund is essentially a kind of container, right, that can hold any kind of investment strategy or an asset. And I think in the previous presentation, Jonathan mentioned a little bit, tokenizing is not really straightforward. It's actually quite complex if you start thinking asset by asset, register by register. So a fund, at least as a starting point, gives you a standard way to bring assets on chain through a vehicle that issuer investors generally understand. So I think that that's one kind of perspective to think about, why to start with this as the vehicle versus, other avenues of tokenization which might have more dependencies. And then I would say from a format perspective, you mentioned kind of the evolution from traditional to ETF to now tokenized. I think the way that we also think about it is, the fund format changes to, instead of saving as an Excel file, you now save as, a smart contract. And if you put the smart contract outside of the firm's firewall, the way that you allow people to connect to it is a little bit different. And so the questions you start asking is, now that I have the contract out there, I've set the standards around, what, how we think about the compliance and the structure. It's then who's allowed to connect to it, and it almost becomes a new type of kind of API, right, in a way, but one that's much less complicated to interact with because it sits outside. And that opens up a lot of interesting opportunities to kind of go to the market and say, what would you build on top of our product if we were to make it available to you? So I think this is some of the ways that we think about the fund and then the format and where the potential is.
Yeah, that's an amazing analogy. I think I'm going to steal that. Andrew. Emma?
Yeah, so at Fidelity International, we really want to bridge, the traditional finance with digital asset finance. And for this, we have two main streams of work. First is, looking at crypto as an asset class. So basically enabling traditional investors to access crypto through crypto spot strategies. And, and from that angle where we really were strong and came in the market a long time ago, basically we moved into fund tokenization. And looking at fund tokenization, we really want to bring the clients at the core of the proposition. We have a distribution-led approach working with clients like Sygnum. And basically, we have two main targets, two new channels. The first channels we see is the crypto-native companies, and that's where Sygnum play a big role for us to access that new broad of clients. There is about 180 billion of stablecoins on chain, looking for reserve management and having the liquidity there. There is as well 40 billion of assets sitting on chain that can't earn any yield today, traditional yield, I would say. And 100 institutions on chain have more than 100 million of assets. So really, those new type of clients are really relevant for us to innovate. Then we have a second type of clients that are more, I would say, the traditional banks that are moving as well their infrastructure into DLT infrastructure. So if I really focus, for this crowd on, on the first aspect, what we have done this year, it's like a sort of evolution back to your question from a mutual fund or an ETF into a digital twin, right? And you need to look at fund tokenization in two ways. What is a digital twin and what is a real digital native fund, which is the future long-term goal of, I think, all of us. Ultimately, the digital twin is an approximation of a fund where I'm bringing a layer between, on-chain and off-chain. And that layer doesn't enable me to do everything that I want, but I mean, it's better than nothing, right? Ultimately, you're trying to move everybody behind this digital twin. So this is what we've done with Sygnum by basically bringing, our money market fund on chain as a digital twin structure to enable Sygnum to get their clients to invest into our money market fund. And then, after that, we bring more utility to that digital twin, bring on the NAV on chain, so that, the on-chain clients can start to do more with this token. And ultimately, we'll work longer term to write the digital native fund, but you need to have a lot of enablers for this to happen that I think we're going to discuss about.
Yeah, you talked about enablers, which is a perfect segue into our next question, which is all about, I think, Emma, you said it correctly, it's a bit of a digital twin at the moment. And when you think about building an ecosystem, you're actually building a dual ecosystem. So really the theme of this question is that tokenizing a fund brings in an interesting challenge because you need to build an off-chain ecosystem of service providers, such as Sygnum Bank, that can provide you fund accounting, custody, connections to different blockchains. But then, we're not just building digitizing traditional products. there's enabling new use cases where users actually want to do things on chain. So there's the off-chain ecosystem of service providers, but then there's this on-chain ecosystem of what can I do with this now that I have it? And really the next question to our panelists is, what are some of the use cases that are top of mind that make this tokenized fund format more useful? And how do you begin to build that ecosystem? So I'll once again start.
I think that's probably the core of what we all together have to figure out. And I think we are coming to solve this. We're coming from two sides. One is you have, let's say, the DeFi world, the fully on-chain world, where I would say the use cases of that the blockchain bring and the advantages of the blockchain are shown in the most, let's say, pure way, but obviously also with challenges because, for example, not regulated, KYC, etc. Maybe not fully worked out, travel rule, etc. For those who know about this, it cannot be really done there. But the features of the technology, the smart contract based, in financial instruments, etc. That's where the innovation actually comes from. Then the other side is you come from traditional finance, from clear setups, regulatory frameworks, etc. And now we have to kind of bring these two worlds together, and that's also a little bit what we see ourselves and our role to be. Emma said that we create, and this is an evolution. It starts with creating digital twins, with starting to step by step bring this value chain on chain, and then over time, at some point, and it will take another while, we will have the entire value chain on chain, and then the true benefits can be leveraged. But we have to do it taking a future has heritage approach, just accepting that where we're coming from, there's a few things we just have to do. We cannot skip. We cannot go too fast. And at the core, that is the regulatory frameworks. Because when it comes to fund tokenization, it is a security. These are securities, so we have to follow all the rules that just have been there, and they also do make sense. In terms of use cases that we see, just to give two very specific ones in this evolution. One is, in our case, we are operating at the interface of traditional finance and future finance, as we call it. And one key challenge that particularly also crypto companies and traditional investors coming into crypto have is collateral management. They want to trade where the liquidity is today, still for the most part on the large, not so deeply regulated exchanges, but they don't want to take the exchange's counterparty risk. So we are building infrastructure, have already done so, and will add such fund tokenization as collateral, basically frameworks where clients can keep assets with us, with the Swiss bank, off-chain, off balance sheet, bankruptcy remote, but we have a tri-party agreement between the client, the bank, and the exchange, so that they have a virtual margin and can trade where the liquidity, the big liquidity is on maybe not so well-regulated exchanges, while the assets are with us and can generate yield, because as a bank we can, for example, put it in a money market fund or US Treasury. So that is one key use case that we see. The second one is that hopefully over time we'll find ways to bridge from traditional finance to DeFi by being able to leverage these tokens also in a more DeFi setup as collateral, etc., while making sure whenever redeemed to fiat or cash, then it can only be done in a KYC manner, etc. But for that, we need lots more interaction with the regulators and for them to be comfortable or get comfortable on this journey with us.
If I may, I'll jump in on what Mathias said, and that's why one of the use case, introduced by Vince earlier, why we brought the NAV on chain is to be able to enable those type of collateral use case, because ultimately by bringing the NAV on chain, then you can start, as a distributor to do basically all your risk management, reporting, enable an experience for your client to see the token as part of the the overall, investment that they have in their wallets. You can start doing marketing as well, because you have basically, this token can be properly advertised in all the dashboards, on all the on-chain dashboards. So that's ultimately, one of the reasons that we work with Chainlink to bring the NAV on-chain, to bring really that transparency. The other use case we worked on, again, linked with collateralization, but more, I would say, in a TradFi setup, is working with JP Morgan on the tokenized collateralization network to enable hedge fund, treasury, corporate of treasuries to basically use the money market fund as well as a collateral, and a bit similar to what Mathias said, but in, I would say, a more traditional context, using blockchain technology as the infrastructure.
Yeah, I mean, collateral, for the folks that don't know the traditional rails, typically someone owes me money, we agree they owe me money, I get the money in 3 days. And if that person goes bankrupt the next day, I'm kind of out of luck. And there's been historical, Lehman Brothers is a great one. I think folks are still trying to get money from Lehman Brothers when they went down. So you really get instant settlement, instant counterparty risk eliminated from that. So with that, we'll hand off to you.
So maybe I comment on some of the use cases discussed, and then can also share a bit about kind of how we think about the ecosystem. So I think like liquidity management makes a lot of sense. A lot of fund managers looking at tokenized money market funds and things of the sort. And I guess like the reason for that, intuitively is if you're going to build a new financial ecosystem, with the purpose is to bring kind of liquidity through time, then obviously the most basic product is one that can earn you some kind of interest, like a basic, banking type like product. And so I think it makes sense that as we think about tokenization, you're just building the building blocks of a kind of complete financial system. And to do that, it makes sense that the starting point is some of these simpler products that serve pretty fundamental purpose. And then on top of that, as you mentioned, like the most financial services move more towards like a secured model anyways. And so these secured transactions or secured financing transactions involving safe collateral or collateral that could be easily valued becomes quite again intuitive that like you would start there as a use case. So I think obviously these are things that we're also thinking a lot about. But in terms of like the wider ecosystem, I guess there's a lot of things that need to come together for this to work. And so I guess from a fund management perspective, there's maybe two ways to think about it. There's the investment side of the fund, so which I think Emma then touch on. You start to get things like the NAVs, the portfolio investments that then need to be reported, valued, etc. So above the line, you have investment activities in an ecosystem there that kind of need to come along, for the journey. And then below the line, you have kind of distribution, right? So eventually, the shares need to be placed into the market, and then you have kind of another ecosystem of partners around that may be able to help you bring that out. And I think on the distribution side, it's probably the easier one to start with, because you're kind of ring fencing the investment content inside a vehicle that can be tokenized. So it's already in the format that, let's say, the new types of investor want to see, want to interact with. Then the question there is, who are the as Mathias mentioned as well, it's a security. So you need to have licensed and regulated entities that are able to distribute these types of products. And I think so that ecosystem is growing. I think it's helpful that in places like Hong Kong and Singapore, you have that licensing framework has really matured. You have more people coming out of sandbox licensing into full operation, and so that gives actually some possibilities now to think about who's already ready to kind of accept these types of products in that format. And it really is important from a license and regulated perspective, for managers to be able to work with them. So I think that's probably where, and then the utility can be added from these types of partners that maybe have the capabilities to build additional services around the product of the manager. I think on the investment side, that one is still a little bit newer. At the end of the day, if we're talking about tokenized money market fund, you're buying traditional securities that, like if you're buying a treasury, you can settle that in a bank account at the end of the day. So that part is going to take some time to see how that ecosystem evolves in terms of whether that bank account becomes a tokenized deposit or there's central bank digital currency or some kind of other wholesale settlement. But these kind of things, I would say, probably are the next step that managers will probably be thinking about. But the immediate kind of opportunity or what is within reach today is probably more on the distribution side and looking at that ecosystem.
Yeah, I completely agree. And maybe a bonus question, because you kind of led us there. Interest rates globally were around 0 for a very long time. And, DeFi really took off in 2020, DeFi summer, and I don't even know if tokenized money market funds have a market in that era, right? And then what happened globally was interest rates, inflation was happening, started to creep up around 5, 6, 7% globally. Now tokenized money market funds almost become, a vehicle of choice. Now that we start to see a bit of easing when it comes to interest rates, now we're kind of going to see, okay, what is the next evolution of the products? And one question is, do you take what is being done in DeFi as a yield generating tool and combine it with the tokenized money market fund to kind of be competitive to traditional money market funds that are in a brokerage account? Or do we see kind of going more out the fixed income risk curve and then putting that things on chain? Does anyone have any particular views on how the product evolves with interest rates? Is kind of, Emma, you're shaking your head out.
Yes. I think it's interesting you saying that it just popped up when interest rates were higher. I think it makes sense from a client need point of view. But I mean, I've been in the space for tokenization space for maybe too long, 7, 8 years. And at that time, I was pitching tokenization, of money market funds already internally. And ultimately, the advantage were really around the operational efficiency and the opportunity, in a low interest rate environment for the portfolio manager to do better than peers, right? Because when interest rates go down, the portfolio manager needs to outperform even more benchmark, right? So the ability to see subscription, redemption, live, on-chain was giving an opportunity for the portfolio manager to outperform, right? So I think, even when it's going to go down, it's going to stay there. But ultimately, at that point in time, because there were no demand, there were no urge, right? Now we have, those products that are live. So even if, interest rates go down, and I think probably going to be, higher for longer or something like that. I mean, it's not going to go down like COVID times. But ultimately, I think now that we have, this infrastructure, the portfolio manager will see the benefits. And because you have brought all those capabilities around it, around collateralization, right? And an ability to do more things with the product, ultimately, I think the demand will stay, right? And back to your question, we'll go over, the other spectrums, right? So again, looking at what the client wants, maybe, at this point in time, the demand will come more from crypto-native young investors that are looking to diversify, into equities, right? And we'll have built the infrastructure that is, will enable all of those different channels, basically. Yeah.
Yeah, that's a great point. I think portfolio management, a lot of people may not know in this room, but an asset manager has a distribution network. So I issue a fund, I have distributors that essentially allow folks to purchase and redeem out of that fund. A lot of the ways that we communicate, or distributors communicate to the asset managers, I think they're still using fax. Can you confirm, Andrew and Emma? We're still using fax in 2024.
Some jurisdictions.
In some jurisdictions.
Not everywhere anymore.
So not a broad faxing across the industry. But even the fact that exists is kind of crazy in 2024. So I think giving the portfolio manager better information, better data to invest instantly is definitely something that, and I don't know, Andrew, Mathias, if you wanted to add to the...
No, in short, it's a bit along the similar lines as Emma, but first, I don't think that we will have very soon again an environment with 0 or negative interest rates. So that means that is a bit of a normalization of economically what happens with interest, and money is not free. And so in that sense, now that the genie is out of the bottle and the infrastructure has been built and is continuing to be built out, I don't think it will go away. It just needed that initial trigger to even get started, and that clearly happened to that massive spike we had. And then secondly, as we've touched upon with the evolution of the use cases, particularly using it as collateral, for example, for managing beta exposure into risk on assets environments, this will still be useful, right? I mean, if you have right now, we're seeing Bitcoin spike. People want to leverage it, etc. They need collateral for over collateralization for Lombard loans, etc. And for that, if this infrastructure is on chain, it will make it much easier, more direct, more seamless for all the parties involved to manage also the risks associated with it. And now that we have it, I think we will continue to use it and build it out.
Yeah, I think there's probably two dimensions of like the product innovation, and I think in terms of the types of investments in different kind of macro environments, I would say even for probably anyone doing tokenization, the setup is pretty flexible. So for tokenized funds or other things that we do at UBS through UBS Tokenized, it's pretty much any product on the shelf today can be tokenized and brought through. The question is, what's the demand of the clients, right? The investors that are on chain, and what does their asset allocation look like in different parts of the cycle? And I guess that would drive a bit the demand for what products to kind of bring through. So I think that investment content dimension is pretty classic in terms of thinking about what might be the next product. I think the other dimension, which is which will always stay, is like innovating the wrapper or innovating like the tokenized product itself, the smart contracts, and how it's connected. I think that piece, as mentioned, already, that's a bit agnostic to the investment content, but having the possibility to connect it into other types of financial transactions, whether that's trading or lending or other types of transaction pattern, like these will continue to be something that I'm sure, regardless of what is the investment inside the fund, will be options that people are looking for.
And a perfect segue into the last part of the discussion, which is all around technology. So the theme here is building for scale. So, as an industry, asset managers have brought money market funds on chain. Everyone seems to be pointing towards scalable customization as a kind of an end use case. And part of that is blockchains. You kind of get composability. You were just saying, decentralized systems, you gain efficiencies through composability. And the question really is, what are the requirements to scale beyond just tokenized money market funds? How do we build more complex structures? How do you think about interoperability? How do you think about data? How do you think about interacting purely from a technology perspective? And I'll start left to right again.
Yeah, so maybe I need to say first, we are still in the build-out that there's still not enough trusted nodes that can actually distribute and manage such assets from a position of being fully regulated, etc. So the first step is actually to convince and have more such trusted nodes, more banks, more regulated financial institutions active in the space as a first step. And that itself is a huge task and is evolving, and regulators and policymakers are influencing this in one way or another depending on the jurisdiction, and we're in different stages in different jurisdictions. So and then secondly, once this is done, we need to be, I think, and maybe the others can then give a more gang-ho kind of outlook. I think we need to be realistic. I mean, once such an institution starts being active in this space, there's still such a discrepancy between this on-chain world, which we can obviously make it interoperable, etc., and all the nice stuff. But the reality is these institutions come from a place of having 30, 40, 50-year-old infrastructure, which they need to feed all of this into and reconcile, etc., with the core banking systems, with the fund accounting management systems, etc., with the subscription redemption processes, etc. And I don't think there will be a shortcut that we can take. This will have to evolve, and these systems will have to be tweaked, etc. So I think that's a shortcut we cannot take if we want to move in that way. It will take years. On the other hand, from a DeFi side, from the on-chain world, we can just have the crypto crowd can basically showcase how it can be done, that it can be more efficient, and hopefully then at least some of the components can be used to leapfrog some of the old infrastructure that the banking system still uses. But I don't believe in everything will just be gone, and we will soon have smart contract-based core banking system which integrates seamlessly into DeFi. I personally don't believe that will happen, unfortunately.
Well, and I think at Chainlink we have that same vision, right? We realize that existing systems are not going away. There's too much value on those systems. And what we do at Chainlink is we enable those systems to have additional interactions and additional connectivity, right? Like some of our work with Swift is a great example. Some of our work in getting NAV on chain from traditional fund admins is an example of that. So maybe there is a shortcut, and it's Chainlink. Passing on to Andrew.
Yeah, so I think there's obviously a lot of things, as I mentioned before, that need to come together. But I think at a very practical level, we start to think more about the technology in terms of the smart contract and standards around that. So some of the tokens that have been tokenized through UBS, right? We starting to have a lot of those discussions around, what's the base token standard that a traditional kind of commercial custody or wallet solution provider will be able to take in without any additional integration. But on top of that, because this is, again, a security, what are the kind of compliance layer that we need to put on top? And so, we've been looking at things like the CMTA standard in Switzerland, right? Across other products that we have as well, to kind of start thinking about, what are those layers that could exist around the smart contract, and as long as and make it as easy as possible for kind of what is already out there in the market today that wants to see this token format, to be able to accept it. So I think that's that's maybe the very practical kind of discussion that's happening in a lot of our conversations with people around how to kind of integrate with tokenized fund. I think beyond that, there's still going to be a lot of other kind of technical standards that need to be worked through, especially on like across the whole life cycle. But I think that's where it's interesting to kind of have some of these interoperability solutions and people building some of these bridges, and we just try to see how we can make it as easy as possible to plug those in.
Yeah, Emma?
Yeah, so for us, we really have a distribution-led approach, and with Sygnum, the client base we're looking at is really, crypto native, and as a result, we're trying to move away from the digital twin and get into the digital native structure, right? And for this, among all what is important, stable coins, interoperability, etc. I think one of the puzzle that is really important is digital TA. You need to be able to manage subscription redemption on chain, on a public chain, so that you can enable basically public tokenized money market fund. And that's really for us one of the long-term goals that we have to again enable the clients to invest into our investment products. Yeah.
All right, awesome. Well, that wraps up our panel. We really thank our panelists from traveling all over the world to come here and have this discussion. Thanks for coming.
Thank you.